traders, this is Robb Reinhold and this is the trading room. We are going into monthly options expiration in April, so let's jump into it. We had a crazy week this week and we might have had a market change. Let's go check it out. In this session, we'll talk about what happened last week. Then we always look at the market with a fresh set of eyes, saying, okay, what is the technical score? We go through all of the sectors, score them from +3 to -3, and then we find the best trades in some of those sectors.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, let's take a look at last week's news. We got our biggest pullback during this run that started in November. So since November, we have not pulled back to the 50-day moving average on the S&P, and we basically closed at the 50-day moving average, slightly above. So here's a big question. Is this bull market over? Well, guess what? Here's my opinion. Flip a coin. Heads, it's yes. Tails, it's no, or vice versa. I think at this point, I think anyone telling you they know whether the market's going to go up or down here, I think it's a 50-50 call here at best. There's lots of times where I'm very clear and I say, hey, I think there's a very clear bull market or bear market. This is where we're going. At this point, I think whatever I say is basically going to be half right, or maybe right, maybe wrong. We're going to have to wait and see. I did the end of day video on Thursday, and I said, look, if the market bounces on Friday, that's likely it to the pullback. The market did not bounce on Friday. And in fact, we had lots of things going the other way. We had the banks come out and announce earnings. JP Morgan dropped the market. We had the dollar spike. We had bond yield spike. We had oil spike. We had gold spike. Everything that is saying, basically everything people do in a risk-off environment, that's what they did this week, and they sold their stocks. We got a hotter than expected CPI this week, and we saw the rate cut odds fall. So right now, June rate cut odds are at about 26%. At the high, they were around 60%. I wanted to take a second and show you where you can get this information. So this is the CME group. I just typed in CME FedWatch tool and it takes you here. And it basically says, okay, these are the odds or rate cuts. So if we go to the May 1st Fed meeting, basically there is virtually no chance of a rate cut. There's a 1.7% chance of a rate cut. If we go to the June, now you can see there's a 27% chance of a rate cut. If you go to historical, you can actually go back and see what were the historical probabilities of the rate cut. Really fun little tool. Some of it doesn't make a ton of sense, but go ahead and go play around with it. It's always fun to see where this information comes from. And again, all this information is directly from the markets and from the options market specifically on interest rates. The market has been excited for 3 rate cuts this year. The Fed has told us they're still on par for 3 rate cuts. Well, guess what the markets say? The markets earlier this year were as high as about 45% chance that we were going to get 3 rate cuts. Now it's only 15% chance. So these rate cuts are off the board. What was the biggest reasons they're off the board? Inflation. Inflation has been sticky. We got the CPI hotter than expected. For the last 2 to 3 months, the CPI has been more than expectations. As you can see here, 0.1% higher. On Thursday, we did get the PPI. So on Wednesday, we got a big drop in the market. Market's down 1.5%. Then we get the PPI and it says, hey, it's not as bad on producer prices. So the market bounced back a little bit. And then really Friday was the big deal. Was the market going to shrug off this hotter than expected CPI, or was it going to have it weigh on it? And I think we know the answer now. Friday was a down day. Friday closed very close to the lows. it's telling you that this news this week had a pretty big effect on market sentiment. So the question is market sentiment over? Again, I think you should flip a coin. That's a better decision than you're probably going to make, because we all have our biases of what it all means. So let's get rid of our biases and just look at the charts. Last week, as I said earlier, was a down week. We had Dow down. This is mostly Boeing. But S&P down 1.5%. That's a pretty decent down week. Look at the Qs though. Only down 0.5%. Then you take a look here. The Russell absolutely slaughtered. Higher interest rates definitely hurt small caps a little bit worse. Gold has had a fantastic run. I mean, look at this chart in gold. What a run. I talked about the breakout a couple of weeks ago. Great run on gold. Like I said, everything that people usually do to take more safety, that's what they did this week. That's not a great sign for equities. This is all just cocktail talk. What do the charts say? For the last 3 months, we have had, every time it's pulled back to the 20-day moving average, it's bounced. As you can see, that changed. That changed here. We didn't get that bounce. And now we sunk below it. And here we are trading down to the 50-period moving average. Look at that long shadow here. Again, it's a small one, but we got that little shadow. There was some buying in that 50-day moving average. The 50-day moving average is our line in the sand. Above that line is telling us we can lean bullish. Right here, right now, we had basically 20 minutes of a bounce on Friday. We cannot call this a bounce. We need to see a couple more candles for sure. Then if we come over here to the Qs, Qs actually had a better week, and they've been weaker than the rest of the market. And you can see we're still in this high base here. And we're stuck right in the middle. We're right between moving averages. The Qs actually look a little bit better than the S&P in my opinion, but we are still knocking on the door of breaking below and holding below a 50-day moving average. The sell-off was pretty broad this week, but you can see little patches of green here. But there were some pockets of heavy selling in here. As you can see, a lot more red than green this week. The question is, this week, what happens this week? And as I said, I don't know. As far as right here, right now on a Friday, I don't know. Tuesday and Wednesday, I will have a much better opinion of what is likely to happen because, like I said, I think it's a coin toss. I think right here, right now, it's too early. We'll wait and see what happens. We've been saying this for the last couple of weeks. We're in the later stages of a bullish move. Don't be scared. Enjoy it while it lasts. We are now at the edge of the cliff. We have to realize that it's over. Now look, we don't know if it's over yet, but by Tuesday, Wednesday, if we've sold off and we're solidly below those 50-day moving averages, we then have to say we admit that this bull market's over. Now for bearish people with a bearish bias, they've already made that determination. People with a very strong bullish bias, they're going to clutch onto that bullish bias and say, no, everything's still good. We're still going to go up. Look, we are technical traders at Maverick Trading. We just trade the technicals. Everything else is what we call cocktail talk. Fun to talk about, but you absolutely cannot trade off of it. First quarter earnings have started. So as always, check your earnings for any of the positions you're looking to put on. Last week was a busy week as far as economic reports go. This week, not so much. We've got retail sales on Monday, and that's about it. And frankly, the market doesn't really even care about retail sales. So this week, it's going to be a much more mellow week as far as news goes. The market is going to have to bounce organically. There's really no news out there on the calendar that's likely to save it. Let's score this out. We are below the 20-day moving average. We are slightly above the 50-day moving average, and the 20/50 slope, that 20-day moving average is no longer sloping higher. We are at a zero. Here's the big question. You can go from +3 to 0 and then go to -3, or you can go from +3 to 0 and then back to +2. Which one of them is it? We don't know yet. We have to be honest and say this market is a zero here. That means we got to pull back. We got to pull back. Any new trades have to be much less bullish than they've been in the past, and maybe we have to carry a few more bears to even things out. Let's take a look at the sectors and how they have shaped up over the last week. Let's take a look at sector performance first. The worst sector was the financial sector. It got hit, and it got hit hard on Friday specifically. We're going to take a look at that sector. What else was weak? Real estate and healthcare. Now, we downgraded these both. Actually, we downgraded financials from a +3 to a +2 last week. One of the few +3s that fell. And we downgraded healthcare to a -2, real estate to a -1. We were expecting these to be weak. Now, materials was also down 3%. That was one of our +3s. A little surprising on that. But for the most part, the +3s held in better than the rest of the market. Let's take a look at the utility sector and score it. Last week we were at a +3. Now we're at a +2. So we're back to the 20-day moving average. We are holding that little bit of support there. If we go any lower, we're going to have to lower this a little bit more. But again, it's a +2 at this point. Next up to communication services. Communication services. I want you to take a look at the last 5 candles. It was a down week. There's no question about it. We are now below the 20-day moving average. Okay. But I want you to look at these 5 candles and compare that to the rest of the sectors we look at. It definitely is downgraded from a +3 to a +2, but it's still holding in fairly well compared to others. Here we go over to real estate. Real estate, we were at a -2 last week. Now we're moving to a -3. We've got our 20-50 cross. This 50 is now moving lower. We have not had a -3 sector in a while. So real estate is at -3. This one has been the weakest for the last month or two. So this should be no surprise that real estate continues to weaken more than the rest of the sectors. Healthcare was downgraded severely last week to a -2. I've got a -2 because I'm just waiting for this 50-day moving average to cross lower, to turn down. We're probably no more than a couple days away from that if real estate keeps weakening. So a -2, on healthcare. If healthcare keeps weakening, -2. Industrials. We've loved industrials. It's been a solid +3. It was a solid +3 last week. You can see we've had 5 down days. Pretty solid down days, but take a look at all the lower shadows here. Green candles on gap down days. Yes, we have to downgrade it to a +1, but the price action was fairly decent on a down week last week. Take a look at the price action compared to the financials. This is horrific price action. You could point to Friday saying, oh, JP Morgan, they ruined the financials. No, they were bad all week long. There was heavy selling in financials. So we're taking this one all the way from a +2 to a -1. Financials are now more negative than positive. Over here to consumer discretionary. Last week we were at a -1. We do have to go to a -2. Again, this is scoring by technicals. We were still hanging out around the 50-day moving average last week. These 5 candles, they're not terrible candles. As you can see, we have 3 green candles in there. And yes, a nasty day on Friday, but the candles aren't bad. But we have to go with the technicals, -2 on the on the consumer sector. Here is another one. These candles are not bad. Not bad at all compared to what we saw in financials and in real estate. We were at a 0 last week. We do have to downgrade it to a -1. But remember, relative strength and weakness. We've got some things that are falling very fast, some things that are falling very slow. If the market bounces, we know the things that have fallen slower tend to recover a little bit faster. So tech, it is downgraded to a -1. This one got hammered. No question about it. We are at a +3. In materials, it's at a 0. Those 4 candles are not great candles. No green candles in there, and just not a lot of good price action here. Going to a 0 on that. And then we have energy. Look at these last 5 candles. Friday was ugly. There's no question about it. Friday is an ugly candle, but look at the 4 in here. Energy was holding on all week long, long lower shadows. Yeah, Friday it got hit. We're still above the 20. We're still above the 50. They're still sloping higher. Energy remains a +3. Let's take a look and see how things moved this week. So our weakest sectors last week, we had tech, consumer real estate, healthcare, all on the weak side, and they all just got weaker. So they all weakened here, real estate to a -3. Our 6 strongest sectors, they weakened as well, but let's take a look and see what held on the best. We have energy, utilities, comm services, still at a +2, +3. We want to be looking for longs in these sectors, and we want to be looking at shorts in these sectors. Sideways trades, I think you can make these in here. For the last 4 months, we have had pretty much all the sectors jammed over on the right, all at +3, +2. This, I love it when it's distributed like this because now we truly have good opportunities to go long, short, and sideways. And in this kind of environment, if you call it correctly, you can make money on all your trades. When we have a very strong market, pretty much all your shorts, they don't work out all that well. So I do like this kind of distribution here because now we can really pick and choose where we want to be long and where we can be short, and we can add some edge to our trading. So let's take a look at some of these possible trades in these sectors.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
Let's start off with the real estate sector. This is the weakest sector out there. Look, Zillow is technically not in the real estate sector. It's technically in the communication services, or it's in industrial. Sorry, I can't remember which one. I should know that. Look, I'm going to put it into real estate, and it has a beautiful, beautiful negative chart pattern here. We had the news that the National Association of Realtors reached a settlement about commissions. It popped up, it's faded back. It popped up, it's faded down. All right. We have moved down significantly over the last 3 or 4 days. There could absolutely be a bounce. You need to play something that will allow you to have a bounce or a base. Looking out to April 26, you could go one more week to the first week in May. Basically, just give yourself enough time to where if you do have a 3-day bounce here, a 3-day bounce here, you've got plenty of time for it to make a new low. For me, I like the 43.45. So looking at 43.45 on our target, I think it's definitely possible, easily to do, and giving yourself 2 weeks on this trade. Next up to comm services. This is one of our sectors that was holding on pretty well to +2. Take a look at Google. Someone forgot to tell Google that last week was a bad week. Look at these 5 candles. Those candles are fantastic candles, and on Friday, we barely had a red candle. Very small red body. What that means is it opened here, and for one point of the day it was higher, and it closed lower. It barely closed lower, meaning there was about the same number of buyers and sellers in Google on Friday. The rest of the market, you just saw big fat red candles. This is a great candle telling you this thing wants to hold up. In a very negative market, let's say the market keeps falling, you know what? This is going to fall as well. There's no question about it. But if the market stabilizes or just stays where it is, this stock wants to go up. Look, I'm not going to be super bullish on this because the market has deteriorated. I'm not like a +3 thinking I want to, run this one all the way up to 170. I'm looking at things like a theta positive bull call spread, or I'm really liking these diagonal call spreads. One thing you do have to worry about, this does have earnings. Earnings are going to be right around at the end of the month after the April 26th date. So if you don't want to be in earnings, you've got to have April 26th as your cutoff. This diagonal call spread is probably what I'm going to do. That gives me 2 weeks to basically write diagonal call spreads before I have to jump out of the trade into earnings. I don't hold diagonal call spreads through earnings, especially on technology stocks that have some volatility. So to me, Google looks absolutely fantastic. But if the market really tanks, it's going to tank everything with it. This is showing you it wants to hold up in spite of that. Industrials was another sector. It went from a +3 to a +1. There's still some good looking trades in here. This is Cummins, CMI, high base. Take a look at this stock last week. This stock held. This stock held very well. Just like with Google, if the market gets crushed, yes, this one is going to fall. There's no question this will fall with the market. But if the market holds in, if the market bounces, these are the stocks that will do the best, the ones that held up the most. I'm not super bullish here. Take a look. Talking about kind of the same thing. A 297.50, 300 bull call spread. I'm looking to play it in this range. It just has to close above 300 in 2 weeks. That's all it needs to do. If it just floats sideways, I'm very happy with this. If it tanks, yeah, it's going to be a loss. Or same thing, you could do what we did with Google, the diagonal call spread. Buy that longer dated May option and then just sell the April 19th. This one only has monthly, so you'll only be able to do that once on CMI. In the consumer sector, it did get downgraded. The selling in the consumer sector wasn't as intense as others, but I still think this is where you want to be short. Here is GameStop. GameStop has been not good. It plummeted 2 or 3 weeks ago and based. We're in a base here, and you can see Friday, we close on our lows right at the low of the base. I'm expecting this thing to break through early next week. I've got 10 as my target. The way I'm going to play this one, pretty simple. The April 26th, 10-11 bear put spread. Right now, the stock's at $10.77. You're probably going to pay about 40 cents for this. That gives you 60 cents of upside, so 1.5 to 1 risk reward. For those of you wanting to get aggressive on the short side, I think this is the trade with just the straight May 17th puts. This thing could easily go down to the 9s. That's a big move. That's a 10% move to the downside on GameStop. And let's finish this off with energy, the last sole survivor of the +3 column. Again, I'm looking for something that's holding up. If the market tanks, it's going to be a problem for all stocks and all sectors. But if we hold in here, I'm looking for things that are holding in. We've got a nice pattern here, a stock that has broken through a prior resistance level. And this week, really just held in there nicely. Whenever things are in a high base, I like to do some longer dated vertical spreads going all the way out to May 17th. So this is giving me 5 weeks. This thing could churn for a while before, as long as it breaks out higher somewhere in the next 5 weeks, I'm golden. This is going to be a great looking trade at the end. If that's a little too long for you, I think this diagonal call spread, you're going to open this up, sell this week, reevaluate the trade on Friday. If the trade still looks good, you've got the May 17th 21 call. And you can either verticalize that or just leave that as just a long call. If you don't like it, if you don't like the way the market's breaking down, dump the trade. It's a diagonal, so it's going to be a small gain, small loss. As long as it doesn't break down below 22, it's going to be small gain, small loss on this trade. Take your money off the table. One of these bullish trades just didn't work out. Those are the trades I have for you. If you have some trades you want to share with the rest of the group, you guys know where to go. Go to the Maverick Trading website, log into the members area, Let's get some chatter going. Let's help everyone make some good trades and make some money. There's times where I'm very bold and I say exactly what I think. And look, sometimes I'm right, sometimes I'm wrong. That's the life of a trader. We deal in percentages, not in absolutes. And I tell you, hey, look, there's a 70% chance it goes up, 30% chance I think it goes down. I talk about trades in terms like that. Here we are, I think it's 50-50. I don't know. And so whenever I don't know, remember, cash is a position. You can wait. You can wait a week. There's nothing wrong with waiting a week until the picture becomes more clear. If you miss a little bit of a bounce, big deal. Big deal. If you miss the first part of a sell-off, big deal. Big deal. It doesn't matter when you take a look at trading over the entire year or even multiple years. Market direction is not clear. Sector direction is clear. We have clear direction of where the sectors are going. And I think if you just look at those sectors and play sectors and forget about the rest of the market, I think you can do really well. I am still leaning to the bull side for one reason. This is coming from a perma-bear. When I was a younger trader, I always looked at things bearish. I was always looking that the market was going to fall. I was a perma-bear. I was always trying to find stuff that fit my bias to the bearish side. I had to work on it because it was hurting me as a trader to where I was truly ambivalent. Didn't care one way or the other. I just want to be on the right side. Over my career, one of the things I've told myself to not fall into the perma-bear status is when economies are getting better, when they're growing, the stock market tends to go up. Yes, there's pullbacks. Yes, there's corrections. But it tends to go higher. We do not have any proof that this economy is going into recession. So I still have to lean more towards the bull side. So if you said, Rob, if you've got to put money on the line for the next 2 to 3 months, I would have to put it on the bull side because the economy is still growing at this point. Whether that proves true or false this time, we will have to see, but I've learned that over my career. And again, this is coming from a bear. This is coming from someone who likes bear markets and likes stocks to go down. I've learned the market has an upward bias, especially when the economy is growing. Everyone have a great weekend. Take care, and we will update you next week on what we see happening in the markets. Goodbye, everybody.